Most people remember one image: Wall Street in October 1929, prices collapsing, crowds outside the exchange, and fortunes disappearing on paper. It makes a clean story. The market crashed, then the Great Depression began. But history was not a single falling line. The crash was the opening shock in a chain of failures that turned a recession into a global disaster. The 1920s had looked prosperous. Factories produced cars, radios, appliances, and steel at extraordinary speed. Stock prices climbed, and many investors borrowed money to buy more shares. But the boom was uneven. Farmers had struggled for years, household debt was rising, and factories could produce more goods than many families could afford to keep buying. By the summer of 1929, parts of the American economy were already slowing. Construction weakened. Industrial production began to fall. Then confidence broke on Wall Street. Selling accelerated through October, and on Black Tuesday, October 29th, millions of shares changed hands as prices collapsed. The crash destroyed wealth and trust, but it did not automatically explain the decade that followed. The deeper danger lived inside the banking system. America had thousands of small banks, many tied closely to local farms and businesses. There was no federal deposit insurance. If a bank failed, ordinary customers could lose their savings. Rumor alone could create a line at the door, and a line at the door could destroy a bank that could not return every deposit at once. Banking panic spread from 1930 through early 1933. Depositors pulled out cash. Banks called in loans or stopped making new ones. Businesses that needed credit to buy supplies or pay workers suddenly could not get it. More companies closed, more workers lost jobs, and more borrowers defaulted. Each failure weakened the next part of the system. The Federal Reserve had been created partly to prevent financial panics, but its response was limited and divided. Some officials believed weak banks should be allowed to fail. Others feared that helping them would threaten the dollar's link to gold. Instead of replacing the money disappearing from the economy, policy often remained too tight. Money and credit contracted when people needed them most. Gold turned a national crisis into an international trap. Major currencies promised conversion at fixed rates, so central banks defended their gold reserves even when their economies were collapsing. They raised interest rates or restricted money to protect the currency. Those choices could preserve the official gold price while making unemployment, debt, and falling prices even worse. The world was also carrying the financial wreckage of the First World War. European governments owed money to the United States. Germany owed reparations. American banks had lent heavily overseas. When credit tightened, this fragile circle of payments began to break. Bank failures in Europe sent fear back across the Atlantic, and countries transmitted the depression to one another. Governments then tried to protect their own producers with tariffs. The United States passed the Smoot-Hawley tariff in 1930. Other countries retaliated. Economists still debate exactly how large its role was, but the direction was destructive. World trade fell sharply when nations needed customers, credit, and cooperation. A global emergency became a contest to push pain across borders. Deflation made every debt heavier. Imagine owing $1,000 while wages and prices keep falling. The number on the contract does not shrink, but the income available to pay it does. Families delayed purchases, businesses cut prices and wages, and falling demand caused even more layoffs. The economy was not simply becoming cheaper. It was tightening around everyone who owed money. By 1933, American unemployment was close to 25%. Banks had failed by the thousands. Farms faced foreclosure, cities built bread lines, and families moved in search of work. The Dust Bowl added an environmental catastrophe across the Great Plains, but it was not the original cause of the Depression. It made an already brutal crisis even harder for rural America. Franklin Roosevelt entered office in March 1933 and declared a national bank holiday. Banks were inspected before reopening, and emergency measures tried to restore confidence. Congress created federal deposit insurance. The government separated some banking activities, expanded financial regulation, and began public works and relief programs under the New Deal. The United States also broke from the old gold constraint and allowed the dollar's gold value to change. That gave policy more room to fight deflation and expand money. Recovery began, but it was uneven. New Deal programs provided jobs, infrastructure, and security to millions, while historians and economists continue to debate which policies produced recovery and which slowed it. The economy improved after 1933, then suffered another severe downturn in 1937 and 1938 when fiscal and monetary support tightened. Full employment did not return until the enormous mobilization for the Second World War. Factories expanded, government spending surged, and millions entered military or industrial work. The Depression ended, but not through one simple law or one dramatic speech. That is why the crash-only story is misleading. The market collapse mattered, but the catastrophe required a chain. Fragile banks, vanishing money and credit, the gold standard, international debts, trade barriers, deflation, and policy mistakes reinforcing one another. A shock becomes a depression when the systems meant to absorb it begin transmitting it instead. The most important lesson is not that history repeats in exactly the same costume. Modern banks, deposit insurance, central banks, and emergency programs were redesigned because the old system failed. The lesson is that confidence, money, trade, and policy are connected. In 1929, one market crashed. What followed was the story of institutions that allowed the fall to spread around the world.